Hey everybody, you know how people always say that market timing doesn't work and you shouldn't try to time the market? Well, you got to consider who is telling you that. And I can tell you, being a brokerage firm veteran and owning my own firm, I knew what they were doing, right? And all of my training was basically, let's gather assets and let's keep people invested because that's how we can earn fees as brokers. So, mutual funds and hedge funds and all these funds are there to keep your assets under wraps because they get to make a yearly commission on you, a yearly management fee. So they don't want you leaving. So they tell you things like, don't try to time the market. It doesn't work. Well, it does work. And if you have a good market timing system, you can be better prepared when the market turns against you or when it turns up and you're ready to go. Here's a statistic I always use, and that's about 70% of a stock's direction comes from the direction of the market. Now, doesn't that make sense? It's a stock market, the market of stocks. So each individual stock makes up the market and vice versa. So if the market's moving up, there's a good chance your stock is also moving up, especially if it's a good quality, strong stock. And the same thing happens on the way down. When the market's moving down, your stock gets its direction from that. It doesn't always happen, certainly. There are stocks that go in opposite directions of the market, and that happens all the time as well. Eventually, they kind of diverge, and then they come back together. But anyway, I just want to show you a couple of things on the screen here about some of the market timing system that I've created here. It's called the Genius Market Timing System. And I'm just going to show you, everywhere you see one of these little red squares, that's where the market is going what I call red. So we have red light, yellow light, and green light. And then so whenever it goes red, chances are it's going to go down. And I'm not saying this is always true. This is a probabilities game. Everything in the stock market is probability. I don't know anything. All I know is probabilities. And the probabilities don't always work out. But if you got a 50% chance of being right when you click a mouse, why not try to inch that up and get some probabilities in your favor? And market timing is one of those things that helps your probabilities. So if you see these little green boxes, those are green lights. So you can take a look at the last green light that we had, and it looks like it was around on January 24th. You can see that the New York Stock Exchange was at about, 16,700 or something like that. And you can see from that green box, it went up all the way until about, let's see, when we got a yellow light, then we got a red light. So the yellow light flashed a caution, and then a couple days later, on April 11th, that's a long time, right? So that's a couple of months, 3-4 months that it went up. So from January to April, that's almost 3 months. So that's 3 months of being on the right side of the market if you would have timed the market and said, okay, this thing is green. Now it's red. Now it looks like it's turning around. I think maybe it's a little dead cat bounce, but I think it's, it went red. As soon as it went red, which was on April 11th, it was at, roughly around 18,000. And now today it's sitting at 17,749 after hitting 17,300. So that's one. You can go back to the prior green bar there. You see that little green box there? That green box was on 11/6, November 6th. And you could see this has been in an uptrend for basically 7 months. From November 6th, it went straight up to, 16,700 from 15,100. All right, so maybe you don't believe me, and that's fine. There's some little head fakes in here too. This little red market went red, and then it went down until it went green. So it was a very short period of red, but it was right when it went red. And then this little green one was not right. So there was one that was wrong, and that's why I call it a head fake. Okay, and so we have rules around our yellow markets and things like that. This red one was right. This green one was right, but it was very short. Let's go back in time a little bit. I think I can do that here. Yeah, here we go. So let's take a look at this one. So this green one right here on June 7th last year, it was at roughly 15,000, let's call it 15,300. And it went all the way up to 16,500. I mean, that's a pretty significant move. And by the way, we had 2 greens within that period of time. So sometimes they go yellow and give you a little head fake, but it doesn't quite turn red. And then here's a red one here on May 2nd of last year. And it went down from there. Not very significant down, but certainly did go down. And then here's a green one where it goes up, right? So, we had a lot of stuff going green on this day, but it was about April 3rd we went green. And I put these on there. I've got these, going back for quite a while, and they mark the markets, right? We can see if the calls that we're making are right. Here's a green one here on January 10th of 2023. In fact, that was the day that I said, I think we're at the beginning of a long bull market. And here we are a year and a half later, still in that bull market. Now, we went up green for a bit. We had a couple of reds in there, so we had a correction below the green for sure. and then we went back up green and then continued to go up. Now remember, that green here was at 15,200, and if we go all the way back to the end of this thing, because you're going to try to, some of you are going to put comments in there, so you weren't right all the time. I know I'm not right all the time, but you know, we're at 15 and now we're at 18, right? So that's a lot of move in there, and if you can avoid those red markets by, you know, getting out when the probabilities are that the market's going to go down, then you could save yourself a lot of money. Now, maybe you don't want to do that. Maybe you're just like, I just want to put it in there and I don't want to worry about it. Well, that's fine. But now you have to have the wherewithal and the emotional capacity to be able to ride the ups and downs, because it's during those downs where you start to question whether you're doing the right thing or not. Right? You're like, oh, am I doing the right thing? Is the stock going to go back up? Oh my gosh. You know, and now I'm reading all this bad news, because bad news sells. And so you start to question yourself, and then maybe you sell right at the bottom. Like, that's not good, right? I mean, if you're going to not time the market, then you can't be selling on the bottom. You can't be using a market timing system the wrong way, right? Usually at the bottom, it feels the worst. It's like horrible. That's like maybe when you should be buying, or certainly still be in cash and wait for it to start moving in the right direction. So don't believe people when they say market timing doesn't work. Create your own market timing system. I've created one here, and the people that are in the cash flow machine use it. And you know, you can go to investors.com, which is Investors Business Daily. They have a market timing system. I have to say, we called the market timing down about a week before they did, but they're, you know, we're usually within a couple of days of each other. And you can create your own market indicators, you know, using the MACD. You can use the RSI. You can use stochastics. There's lots of different momentum indicators that you can use for market timing. So I highly recommend that you employ market timing in what you do, because timing the market does work. It gets those probabilities in your favor if you heed it. Otherwise, you're just a buy and hold investor that's hoping that the inflation is going to take you up over time, which it probably will, but maybe you could avoid some of those downs during that period of time. All right, thanks for joining me. I'll see you on the next video.